What's up everybody? GenExDividendInvestor here. In this video I'm going to show you why so many experts are warning that the stock market may be flat for the next 10 years, and why dividend investors will be smiling all the way to the bank if that's true. So if you love dividend investing videos like this, then please hit that thumbs up button, subscribe if you haven't yet, and click that bell notification. Okay, you might have seen some of the headlines recently where people are forecasting that we'll have another lost decade in the stock markets. A lost decade is when the market doesn't make another new high for 10 years, i.e. it goes sideways or down or whatever, but is effectively flat. It's a term that first described a period in the 90s when Japan experienced economic stagflation, and then again it was used to describe what the S&P 500 did from 2000 to 2010. So who all has said that the 2020s will be a lost decade? Well, Ray Dalio for one, the famed billionaire hedge fund investor. So has Blackstone's executive vice chairman. In fact, yesterday, Bank of America warned of 0% returns over the next 10 years. Depressing, right? But here's the good news. Bank of America also highlighted one specific approach that could be critical to investors over the next 10 years, and that's reinvesting dividends. In a recent note to investors, they said that the simple act of reinvesting dividends could yield a total return equivalent to the S&P 500 at 6,000, assuming payout growth stays near its long-term average, end quote. That could mean a 33% return for dividend investors versus a 0% return for growth investors. Before I show you how dividends can save your butt if the markets go nowhere for 10 years, let's look at what the S&P 500 did from 2000 to 2010 so it really sinks in. On the left we see that in August of 2000, right before the dot-com crash, the S&P 500 was at about 1,500. Then it took 8 years to get to around the same point until we had the 2008 crash. And then it wasn't until 2013 that we finally kept climbing past that 1,500 level. So for 13 years the S&P 500 basically went nowhere. In fact, if you'd invested into the S&P 500 in December of 1999, then by December of 2009 you would still have been down by 9% from where you got in. Wrap your noodle around that. How do you think you'd feel about the stock market if it went down and sideways for 10 years if you were a growth investor? Would you have the fortitude to keep investing? It's really important to reflect on that and to mentally prepare yourself for when it eventually happens. Investing is super easy and fun when we're in bull markets like we've been in. It's a whole different enchilada when things are crappy. But crappy markets are when investors are made and broken. I've seen so many people quit investing in bear markets, and I've seen so many people start investing in bull markets. The people who become wealthy are the ones that keep investing in all markets. However, as I'll show you, dividend investors are fine with flat markets and down markets, so maybe I shouldn't be calling them crappy. Take a look at this data of the total percent return by year for the S&P 500. Imagine a minus 9% return in 2000, a minus 12% return in 2001, and minus 22% in 2002. Or heck, a minus 37% drop in 2008. That's the reality of the markets. Yet the people who didn't quit in 2008 got rewarded by the largest bull market run in history. Lost decades are often surrounded before and after by great performing markets. Thus, you can usually expect bull market years, bear market years, bull market years, etc. So why are dividend investors excited by bear markets that go sideways for 10 years, but growth investors hate them? I thought I'd explain this clearly in my video about how dividend snowballs love market crashes, but I still get comments from people who send me headlines about a lost decade in the markets and then ask me if I'm concerned, so I must not be doing a good job explaining why dividend investors are happy in all market conditions. Let's first look at a growth-only investor. The growth investor is primarily trying to buy low and sell high. In a flat market, some of the stocks go up, some will go down, but for the sake of argument, let's say he also goes sideways as the market does. The more the markets are flat, the more pure growth investors usually miss out and freak out. Now to be fair, good growth investors buy when things are on sale, but flat or declining markets still tend to be harder on them than dividend investors. It's not just growth investors that are worrying about crappy markets, but it's also retirees who are using the 4% rule that are also getting more stressed. That 4% rule, recently updated to be 4.5%, is a strategy where you sell 4 or 5% of your stocks each year, adjusted by inflation, and if history is any indicator, then your portfolio has a high likelihood of lasting at least 30 years as you sell some of your principal to pay for your expenses, which is how long most people live in retirement. Here's a picture I found which shows how often in the last 100 years that 3%, 4%, and 5% withdrawal rates from portfolios would provide reliable income for 30 years based on different portfolio allocations. For example, on the left are portfolios of 100% stocks, all the way to the right where it's 0% stocks, 100% bonds. What you see is that the 3% withdrawal rate had a 100% success rate for a 100% stock portfolio, almost 100% with a 4% withdrawal rate, and about 80% with a 5% withdrawal rate. I'm more conservative, so I'd want the near 100% success rate if I wasn't a dividend investor. Or you can see if you had a portfolio of 0% stocks and 100% bonds, then your 5% withdrawal rate only has around a 30% success rate of lasting for 30 years, which means you'd probably run out at year 20 or whatever. There are a lot of variables about the 4% rule, so I recommend researching it if you're interested to learn the various pros and cons. Anyways, I've talked to retirees who were forced to sell shares in down markets because they were doing the 4% rule, and they hated it. What happens in the market unfortunately significantly impacts them, and they're even worried about outliving their portfolios. Insanity. Here you are finally in your retirement years, and you're worried that if you don't die in time, your portfolio will run out because the 4% rule didn't quite work out as you hoped. However, the dividend investor isn't stressed because he isn't selling his principal. The dividend retiree is having cash flow which trends up usually faster than inflation due to dividend hikes. And if you aren't retired, then you're still happy as a dividend investor because, like Bank of America explained, reinvested dividends. When markets are flat, your reinvested dividends grow even faster, and that faster compounding makes flat markets great for dividend investors. Now I'll show you an example comparison of someone who invests $100,000 into growth stocks during the last decade versus someone who invests $100,000 into dividend stocks in the last decade. So Growth Guy invests $100,000 into non-dividend stocks, and at the end of 10 years his portfolio is worth, you guessed it, 100 grand still. If this was happening while he was in retirement, then he would be selling his stocks and watching his portfolio value continually drop. Some of his stocks might have gone up and some might have gone down, but the likelihood is that overall his stocks have trended down in down markets, as very few people can consistently outperform the market. Now let's look at Dividend Guy, who invests $100,000 into some dividend growth stocks, ones at an average 4% yield and an 8% dividend CAGR. I'll use my Portfolio Growth Simulator tool, which is one of the tools that's part of my Best Dividend Spreadsheet Portfolio Tracker product. I put in 100 grand for starting portfolio value, along with an 8% CAGR and a 4% starting yield, and $0 for stock price increases and $0 for additional contributions. So at the start his account value is $100,000 and it would generate $4,000 of dividends a year, which are being reinvested. At year 10, the account would be worth 164 grand and it would be generating about 13 grand of dividends a year. So Dividend Guy ends up with a portfolio that is 64% higher than Growth Guy, and he has the option to decide to use his dividends as cash if needed, all the while still seeing his principal probably trend up like his cash flow is. The Dividend Guy is nice and doesn't mention that dividends aren't irrelevant to the poor Growth Guy who sweats more and more the longer the markets trend sideways or down. What the Dividend Guy who is reinvesting his dividends understands is that the slower the stock prices go up, the faster his dividends will grow over time because his dividends keep buying more shares faster, and the compounding just keeps increasing. But at the same time, if stock prices are going up, he knows his dividend snowball is still growing, just not as fast as when the market is flat or going down, so he's still happy because his portfolio value goes up. I'm not covering inflation or taxes or types of brokerage accounts, but you get the point. Dividend investing in quality companies is a thing of beauty, and now you can see why you'll be excited if we head into a lost decade. So why do all these experts think we might go sideways for a decade? Well, one reason is because they think that some companies will have lower levels of profits and cash shortfalls due to the pandemic, which also usually means their debt will be increasing, and then when the pandemic is over, they will have a big debt anchor slowing down their go-forward growth. Another reason is because some experts think that globalization has peaked, and now companies will waste money and time switching back to onshoring as well as to duplicating supply chains so that they can insulate themselves from what's happening right now, i.e. clogged supply chains around the world. That means they'll have to spend money to get back to where they used to be, favoring reliability over lower supply chain costs, all of which could further slow down their growth and ultimately contribute to a lost decade. Another reason to think we're on the cusp of a lost decade is due to market euphoria. Right now it feels like everyone is in the market and is winning. When my realtor is asking me about Bitcoin or when my son is asking me about GameStop, well, those are all signs that the market is too hot and will change. My son is years away from being able to get a driver's license for reference. However, if you're watching this video, then I'm confident that you're smart enough not to panic during lost decades. You probably understand that the stock price isn't the same as the company. There were years and years where Amazon's stock price was super low even though its business metrics kept improving. The same is true for Microsoft, where its stock just meandered for years. Stock prices can take years to reflect the underlying business. Sometimes they overshoot for a while on irrational exuberance, and sometimes they undershoot for a while and the cycle continues. I personally don't want to be held hostage to having to sell stocks to make money, and I want to be making true passive cash flow in all markets. And I want a low-stress lifestyle regardless of how macroeconomic conditions are blowing. I want an investing strategy where I make money when I'm sleeping or playing video games. Of course, even if we have a lost decade for the S&P 500, it doesn't mean all asset classes trend sideways. The stock market is cyclical, and often when one area is underperforming, another is overperforming. So US stocks might be bad, but international stocks might be good, or emerging economy stocks, or bonds, or whatever. US small caps sometimes do better when the S&P 500 is doing poorly. So consider diversifying your portfolios depending on your needs and risk tolerance. I personally put the majority of my net worth in dividend stocks, but I also have some growth stocks and some crypto and some real estate. But I love my dividends the most. The key is to invest intelligently. No one knows what the future brings, thus none of those experts know if we will have a lost decade. Regardless of what happens, I feel confident that in pretty much all market conditions, people will still be going to McDonald's, they'll still be playing on their Xbox, they'll still be buying Band-Aids and using toilet paper and brushing their teeth and using all those products and services that the companies I own provide. So keep investing in great companies and I bet you will end up doing very well over the long run, especially as a dividend investor. Okay, now I'd like to shout out 5string Killa, who is a YouTube subscriber of mine that has just started supporting me on patreon.com at the Aristocrat tier. I'd also like to thank Sunset, who just joined up. Patreon Aristocrats gain access to my dividend portfolio tracker spreadsheet tool, along with they gain access to multiple private channels on my Discord, including one where I let people watch my videos before I release them to the public, as well as I often let you vote on which thumbnails you use for my new videos or what title I should use. Finally, don't forget to join my free dividend Discord, a place where thousands of dividend investors hang out and chat. Thanks for watching and hitting that thumbs up button, stay positive, and I'll talk to you again real soon. I am not a financial advisor, and these videos are for entertainment, inspiration, and educational purposes only. Investing of any kind involves risk. I am only sharing my opinion with no guarantee of gains or losses on investments.